Alright guys, in this one we're going to go through another expansion on general journals, and that is to include inventories. Now this starts off okay and it gets a little bit complicated just in the way that it includes so many more accounts. So we started off with journals that affected 2 accounts. Some of these are going to affect 5, maybe 6, depending on what they pay with. So we're going to start off nice and simple and we're going to work our way through. There are 4 examples on these slides, and then I'm going to do part of one of the questions on the workbook as well. Okay, so inventories. So when we think about inventories, we're thinking about specific items that we have purchased to resell. So for example, if Scotch Oakburn bought a car, that would be an asset to Scotch Oakburn. It would not be inventory. If Clove was to buy a car, that would be an asset to Clove. In terms of motor vehicle, it wouldn't be inventory. However, if a car yard bought a car, they are buying that car to sell. That is inventory. Okay, so we're looking at goods that we're selling. That's where we're talking about in inventories, and it can change for everybody. Computers would be inventory for a computer shop, but they wouldn't be for a school. Okay, so you've got to think about what they're selling to make their money. That is where we're looking at inventories. So this first one, we're starting off super simple. The only complicated part of this is that it's got GST on it. So we purchased inventory on credit for $451. So straight away I start thinking about which accounts are impacted by this. Inventory is an asset going up, so it's going to be a debit. Credit, so cash at bank, if I paid with cash at bank, would be a credit. It's not. So we're going to have to make an account for Midland Appliances. Don't put receivable or payable. If you get it wrong, you're just giving them a chance to hurt you. So we owe Midland Appliances that much money. Now, some of that money went to inventory, some of it went to GST. So we're going to divide that by 11. And we're going to have $41 going into GST clearing, and we're going to have the remaining $410 going into inventory. Okay, so at the moment, if we look at our little T account, if we look at that for inventory, we've just put a debit in there, 410. We've got $410 worth of inventory sitting in there. And then when we sell it, we're going to have to take it out of that account. Okay, so pretty simple so far. Let's look at another one. So very similar, bigger amounts. We're going to try it again. So we purchased inventory, so straight away it's an asset going up. How do we pay for it? Not by cash at bank. We have to make an account for specialist beds. GST is going to go on the purchase. Okay, so we owe the full amount to the business. We don't only get to pay part of it. And we need to find out what that is divided by 11, which is 135, which makes 1350, the amount of inventory we actually bought. Now, there are lots of different types of inventory systems. We are going to use what's called perpetual inventory, where you just chuck it all in there and take out whatever. The alternate methods are things like FIFO, so first in, first out, and whatever inventory you bought first, you have to sell first. And if you buy inventory at different prices, it gets complicated. There's also first in, last out, which is the first thing you buy is the last thing you sell. I will double check, but I believe that you will only need to do perpetual inventory for this, which means you just chuck it all in an account and you pull out just the amounts. Okay, so you don't have to figure out what you bought when and how much for. So this one again, if we're looking at the inventory account, we pretend that these are the same. Inventory went up by 410 last time. It's now going up 1,350. So we have $1,760 worth of inventory in our business. So what we might be thinking at this point is, what on earth happens when we sell it? Okay, so let's keep our T account there with our 410 and our 1,350. This is our inventory so far. Okay, and in this transaction, they have sold inventory for cash. So let's work out what we know first. We know cash, we're looking at cash at bank. Okay, and that's going up. We should also know from our practice so far that sales are going to be affected. So sales are a type of revenue and they're going up, so they're going to be a credit. We also know that GST is going to be affected, and that's going to go with the sales. Let me just divide that by 11. We've got $32 GST, which means we have $320 sales. Okay, so when this goes on the financial statement, sales is going to be our revenue, and we're going to take off all the expenses, and we're going to find how much money we've actually made. Cash at bank and GST clearing are going to go on the balance sheet, which is separate, has nothing to do with profit or loss. So the sales take away the expenses, give us the profit. But there we're saying we're selling $320 worth of stuff. We have to figure out how much that stuff is actually worth, okay? Because we're not making $320 profit on this. We're actually only making $100 because we sold goods that were worth $220. Okay, and how we do that is we have two accounts that we look at. We look at the inventory, okay, and we know that if we're selling inventory worth $220, this has to be going down $220. Okay, so that's a credit. Okay, we've sold $220 worth of inventory, but we know that there has to be a debit. Otherwise, this does not balance. So what we're going to use is an account called, not that, cost of goods sold, or COGS, as you'll see it referred to. And what happens when you do your financial statements, you'll have sales less cost of goods sold, which will give you the gross profit, less expenses, which will give you the net profit. Okay, so there's two new accounts being introduced there. The main one that we haven't seen before is cost of goods sold, and we've also got to consider how inventory impacts these transactions. Okay, so let's try another example just like this. So in this example, they've sold inventory on credit to April Jones. There's GST included. And we've also got the recorded price of the inventory there. So lots of different accounts impacted with this one. And in terms of journals, this is almost as complicated as it gets. Okay, so what I recommend you do is you start off with what you know. Okay, so we know we sold credit. Credit's an asset going down. So inventory is going to be a credit. We know that sales is going to be impacted. And wherever we have sales, we have GST. We also know that our cash at bank is going to go up, or rather our account for April Jones is going to go up because she now owes us money. Okay, and we're going to try and get this to balance. So April owes us $1,320. Now on that sale, we have to take into account our 10% GST. So we divide that by 11, and we know that we have $120 of GST, which means that our sales was $1,200. But But what about that inventory? Okay, it says there that the inventory cost $680. So a liability going down, we've got a credit of $680. We have to counteract that with cost of goods sold. Okay, so whenever you sell inventory, you need to take it out of COGS. Now, if you want to go and do some practice ones now, might be a good idea. Otherwise, we're going to go on with returns. So with returns, we're essentially undoing the original transaction. Okay, so originally we would have sold Mr. Powell these goods for $55, and we have to undo that now. So when I'm getting the hang of these kind of things, I like to first look at what originally would have happened. Okay, and you do this in the columns of your exam or your test, or on a scrap piece of paper. Don't let it confuse the markers as to what you're actually doing. Okay, but originally what would have happened is we would have had sales, we would have had accounts receivable by M. Powell, we would have had inventory, we would have had GST, and we would have had cost of goods sold. So I'm going to write them all out so that when I reverse them, it makes it easier. So when I originally sold them, M. Powell would have owed us more money. So that's an asset going up, which is a debit. We would have had GST clearing of $5, and we would have had sales of $50. Okay, we also would have sold some of our inventory. So an asset going down is going to be a credit. Okay, $38, and the only thing left is our cost of goods sold for $38. Okay, so that's what originally happened. Okay, and all we're going to do to reverse it is literally flip it on its head. Okay, so all the debits are going to become credits and all the credits are going to become debits. So we can go sales, GST clearing, inventory. Order's not important, just put your debits first. M. Powell, COGS. Okay, and everything flips. Okay, now that to me is a million times easier than trying to figure out, well, sales was originally a credit, now it's a debit, where does the GST go? What is M. Powell's account doing? Okay, so if you write out the original transaction, then flip it. Okay, and make sure at the end all your debits are equal to all your credits, because if they're not, you're going to have problems with it. So now what we're going to do, I'm just going to grab some from Journals 3 Inventories. This one, you can't see it, but we're doing a bit of 3.3. Okay, now I'm just going to pick a couple, so June 1st, 4th and 6th, and do the journals with you. Okay, so date 1st, on the 1st of the 6th, they started the business with land, which is an asset, buildings, which are an asset, furniture, asset, and cash at bank, asset. Okay, so the land was worth 30,000, the building's worth 50,000, the furniture is worth 15,000, and cash at bank we're looking at 2,000. Well, that's pretty much it, except it doesn't balance. So we've got to find a credit. Oh, a credit that is worth, what have we got there? 50, 60, 70, 80, 90, $2,000. Oh, getting old. Okay, so our credit in this case, the owner is putting stuff into the business, therefore we're looking at owner's equity. And if you have the name of the owner, you pop that in there too. Our narration, owner commenced business with assets. Try and get all that information in there in the least amount of words as possible. Okay, next journal. So 4th of the 6th, we bought inventories for 3,300 from motor oil. Doesn't say anything about paying cash or check, so we're assuming that that's going to be an account payable. But our inventories, which is an asset, is going up. It's going to be a debit. We also need to think about GST clearing, and we need to think about motor oil limited account. So the purchaser is inventories, which means GST stays with that in a debit. And motor oil gives us the credit. Motor oil is going to have that full amount because they pay us the full amount. What is the full amount? 3,300. Okay, and then we're going to split the GST out when we put it in inventories. Check our sides balance, which they do. Awesome. We need a narration. Purchased inventories, tax invoice 108. Okay, if they give you any numbers, any check numbers, any tax invoice numbers, just put them in there. Oh. So, last one of this example. On the 6th of June, they sold inventories with a cost price of $2,500 for $4,466 cash, and we've got a tax invoice there as well. Okay, so they sold the inventories. I'm going to look at a basic sale first, and then I'm going to bring in the inventories. So I know that my cash at bank is going up, the debit, and that just goes up by the full amount. So we sold it for 4,466. And I know that for that cash at bank to go up, we need sales and we need GST clearing. I had to drag my calculator out then, that's a bit sad. Okay, so we've got that, we've got the sale accounted for. Now we've got to think about our inventory. So if we sold inventories, an asset going down, we're looking at a credit. And that was worth 2,500. Now you might be wondering why that 2,500 doesn't have GST on it. If you think back to here, when we bought the inventories, we already took the GST out. Okay, so if we take it out again here, we're going to be double dipping, and when we get to the end of the quarter, we're either going to pay too much GST or claim too much GST and get in trouble. Okay, so you only have to take it out once. So you take it out when you purchase it. Therefore, when you sell it again as cost of goods sold, it's already out and you don't need to worry about it. Okay, so that's pretty much it for GST and inventories. So have a go at those workbook practice questions, and you should almost be able to do all those exam questions now. We do have bad and doubtful debts to look at later, and we also have depreciation, but they won't come into it at this point. Good luck.